Good morning and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And joining me again at MarketSite is Chuck Self. He is the Chief Investment Officer over at iSectors. We're going to talk about investing in your portfolio when the markets turn down and we eventually get back into the bear market. Now, this is an interesting conversation, Chuck. S&P is almost at all-time highs. Nasdaq comp broke all-time highs again this morning. What are your thoughts going into potentially a bear market, and what's the best way to invest if you think that's where we're going?
Well, I'm not sure we're going there, but I do think that it's going to happen relatively soon. We've had great earnings, and so that's why the markets are at highs. But David Kelly over at JP Morgan likes to say that the stock market is a monotheistic religion and that it only believes in one thing, and that's earnings growth and the rate of earnings growth. And earnings growth is not going to continue to rise as much as possible. So I don't know when the bear market's going to happen, but we have to be ready for it, and especially financial advisors. And so the biggest problem that financial advisors have especially is keeping their clients invested through the bear markets, and that because what they'll always do is sell at the bottom, and then they'll wait until the recovery occurs, and then they've missed out. And so it's very important to have the portfolio structured so clients will stay in the portfolios when we go through the bear market.
So you're talking fully invested regardless if we're in a bull or bear market?
Yeah. Our view is cash is trash, and even though cash rates have come higher, over time cash barely beats inflation, and then after taxes, to it's a taxable account, it doesn't. So you need to stay fairly vested. And we believe you got to go beyond just stocks and bonds.
Right, so then that was my next question to you. So you're fully invested, but what about diversification?
Yes, you got to be fully diversified. And what we mean by fully diversified is that not only do you own equities, domestic and international, bonds of all sorts, but you also have to have asset classes that are low correlated to stocks and bonds, such as alternative asset classes. And you still have to have a large percentage in stocks because over time stocks are going up, but you own bonds and these alternatives, so people will continue to be invested in stocks through the thin times as well as the good.
So what type of strategies do you prefer and why?
Well, we preferred liquid alternative strategies, strategies that are traded on exchanges such as Nasdaq, but again have low correlation to. What's
an example of a liquid?
Well, we actually manage one, PMPT, the iSectors Post MPT Growth Fund, which is on Nasdaq, and it's a strategy that's tactical in nature in that it will go between stocks and bonds, and when the signals show that stocks could be in trouble, you will be able to go in bonds. And so that's one example. And then there's others such as commodity funds, hedged funds. There's a wider range of liquid alternatives that individuals or advisors could utilize these days, and for the most part, client portfolios are under-diversified. And they're not even rebalanced between stocks and bonds properly, and they don't have enough in the alternative space.
All right, well, thank you very much for joining us at MarketSite as always.
Thank you, Jill.
And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.